Hey, welcome back to the channel, guys. My name is Leo. So, wow, we were really surprised yesterday with those tariffs. Nobody in the market was expecting them to be that severe, and the market hates unexpected news, and so everything has sold off. So we're going to kind of go over what happened, what's going on with the tariffs and all that, but then we're going to get into where do we go from here. So let's go ahead and dive in, take a look at this. So here's the list of the tariffs. You've probably seen this going around on the internet. Some of these are really high, but how they calculated it seems it's very arbitrary. So basically what they're doing is they're taking U.S. exports. So in this case for Malaysia, it's 27 billion, and the imports being 50 billion, and an imbalance of 25 billion. So they basically they're dividing it, and then that's how they're coming up with the reciprocal tariff, basically. So it just seems kind of arbitrary. And the severity of these tariffs on a global scale, it feels more like Trump is open to having these countries come to negotiate with him. So, for example, his son had tweeted out on X. He said, I wouldn't want to be the last country that tries to negotiate a trade deal with Donald Trump, his father. The first to negotiate will win, the last will absolutely lose. So even though they had said that these are non-negotiable tariffs, everything is always negotiable. And I would suspect that he's raised the bar so high, he probably wants something in between what we're seeing and then what's going to end up being negotiated. I do expect he is going to keep tariffs, because he's talked about for a long time, ever since like 80s or 90s, he's talked about how he's felt that the trade imbalance was a big problem. So I don't expect tariffs to go away completely, but I don't expect them to stay as severe as they are right now. For example, if you're trying to buy something and you come in with a ridiculously lowball offer, and then they counter with something more reasonable, like let's say that they're selling something for $50,000, and then you come in, this thing is terrible. I can only pay $20,000, and then they freak out, they're angry, or they're insulted, and then they come back, well, we'll take 35. Whereas if somebody comes in originally saying 35, then they're still insulted and they want it to be higher. So I feel like that's kind of what's partly going on here. But I kind of want to explain what tariffs are, how they work, and do they or do they not cause inflation? Because there's a whole lot of confusion and talk. So let's just come over here and take a look at what I've broken down here. So this is basically what we're going to talk about first are the immediate effects of tariffs, and then we're going to talk about the little bit more medium range. So the way that a tariff works is whenever you import a good, or if you're a U.S. company, you import the good to the United States. So let's say that you're a company and you purchase this shirt here from Vietnam, and let's say that shirt's $10. Well, let's say that now there's suddenly a 20% tariff. When that shirt gets to a U.S. port of entry, it's going to be charged a 20% tariff, meaning that the U.S. company has to pay $2. And now the total cost for that good comes to $12. Now, this does raise revenue for the government, and how much of it, because it's not a direct one-for-one. For example, like it's not necessarily that you're going to have 20% inflation because there's a 20% tariff. It's going to depend on the exporting country and the U.S. company as to how much of that cost they can absorb. Now, what that means for the exporting company is that this ends up being a deflationary for them, but inflationary for the importing company short term. So what ends up happening is because costs are raised on the overall goods price, that lowers demand in these other countries. And so the theory is that, well, that's going to bring back certain manufacturing into the United States. So as these other countries experience deflation, meaning that their economy goes into a recessionary, contractive type of environment, because there's less demands for their exports, what ends up happening to ease those tensions is that their central bank, their monetary policy begins to ease. So you see more money printing around the world end up happening as a result of this, to kind of stimulate the economy. Because whenever you think of if the economy is inflationary, it means that it's growing. Things are getting more expensive, assets are growing. If it's deflationary, it means that stock prices are falling, your export costs are going down. But you don't want too much of either, or really you don't want deflation at all, really. Ideally, you want very little inflation so that you have a healthy growth within the economy. Now, this is if they choose to print money in response to this, we are starting to see other countries saying that they're going to impose reciprocal tariffs, which is not good, because if this ends up being a situation where everybody starts doing reciprocal tariffs, you end up getting into a stagflationary type of environment, meaning that inflation basically across the board just stays stagnant, and it gets very, very sticky. So you don't want that to be the case. Now, short term for the importer, being the United States in this case, it is inflationary because costs do go up, and we can't immediately start manufacturing shirts. And even if we do, it's going to be at a higher cost than what these other countries like Vietnam can do. So short term, it is definitely inflationary. But in this situation, this is where it starts to change, because as these other countries around the world begin to have to print money, they're debasing their currency, they're devaluing their currency, whereas the United States, they have a tightened monetary policy right now. So as you see currencies around the world begin to decline in value, the dollar will actually strengthen as a result of this in relation to their currencies. Now, this is where it gets a little bit more interesting. So, for example, if the dollar strengthens, what that means is that's going to increase demand for U.S. Treasuries. Now, if you have a lot of demand for U.S. Treasuries, what ends up happening is the interest rates come down. We talked about in a previous video how the government has $9.2 trillion worth of debt that they're wanting to refinance, currently sitting at 2.8% interest rate. And if they had to refinance it at current rates, it would cost them like an extra $100 billion a year in interest. So I guess this could be a sort of 4D chess move to try to force interest rates down by strengthening the dollar. But it's hard to say, because there's so many working parts here when you're talking about this level of tariffs on a global scale. It's going to depend a lot on how these foreign countries respond, and whether he's looking to do negotiations at all, or really it's kind of a waiting game at this point. We need to see what the other countries are going to do. Are they going to negotiate, and etc. But assuming that the dollar does strengthen, risk assets like Bitcoin, crypto, the stocks, they typically don't like that, because what that means is that we're in a tightened monetary policy. There's not as much liquidity going around. So it's not optimal, but at the same time, it's not catastrophic for crypto, because you are going to see countries around the world having to print and increase their global liquidity. We're already talking about, or we're already seeing the European Union talking about taking drastic measures, which I see as they're going to print money to stimulate their economy, which they're already doing. We talked about that in yesterday's video. So I expect that we're going to see more of that, which could help hold up risk assets. Now, when people say that they're not inflationary, that's a little bit more medium term, because as the dollar strengthens because of the tightened monetary policy, and as these exporting countries' currency, as it degrades, what ends up happening is the dollar is able to purchase more because it's strengthened against these other countries' currencies. So in that case, inflation would come down. But if the goal here is to do this because of inflation, that's ridiculous, because inflation is already coming down. It's at like 2.5%. It's been trending down ever since it peaked at like 9%. We're practically done with inflation. So if the dollar strengthens too much, right? So CPI is expected to come in at 2.5% for March and April. So if inflation were to go too low, meaning that we are going into a recessionary environment, we're seeing that it go into a deflation, then we're seeing that means that stocks, assets of all kinds start to contract, and the Fed will turn on the money printer very quickly to stimulate it to get it back up to that 2% target of inflation growth over time. So I feel like this is more of a negotiation tactic, if anything. I think that he's trying to rebalance trade deals, and it's not necessarily that, because it's not reasonable to have a small country like Malaysia take in as much exports from us as we do imports from them, because they aren't the same size as us. That'd be like going out to a party with your really rich friend and him expecting you to spend as much money as him. The incomes are just not comparable. It's just not going to work. But that doesn't mean that there's not some other sort of a trade deal that he may be looking to do for the US's benefit. So ultimately what it comes down to is we just have to watch the markets. We have to see what's going to happen. We have to see how these other countries are going to respond, and then we can get an idea of where we could be going from there. So until next time, y'all take care. If you have any questions, comments, leave them in the comment section down below, and I'll see y'all next time.